What is up, everybody? Isaac here with Civil Engineering Academy. I'm excited to be with you today on this podcast episode. Thanks for giving us a listen and a like and a subscribe or a comment. All of those things help the old algorithm out. But we are excited about today's podcast episode. Today, I bring a special guest, Brian Armstrong, who is a structural engineer in the San Francisco area. And we talk about his journey into not only being a civil engineer into the structural world, but also some of this interesting stuff he's doing on the side of all of this, which is running a group called Progress Capital Group, which works on real estate deals in terms of an alternative investment outside of your typical 401ks and other options that are given to you. So we talk all things real estate. We talk about syndications, how you can benefit from using them, and kind of opening your eyes to all things related to that. Hopefully, within the interview, I'm asking all the questions you may have asked, because I know I did have a ton of questions regarding this, but I definitely learned a lot. Hopefully you will too. So if you have any interest in real estate and you're a civil engineer out there, this one is relatable to you. I'm excited about it. So without further ado, let me get to Brian. He's going to share a wealth of knowledge with you. It's going to be coming up right after this. All right, we are live. We're rocking and rolling. Brian, thank you so much for joining me on the Civil Engineering Academy podcast. I appreciate you doing this with me.
Oh, absolutely. Thanks for having me.
Well, I guess a little background for those listening. I wanted to connect with you. I think it's fascinating that you're a civil structural engineer. Let's dive into this other world of investing and investing your capital into some other stuff that's out there. I just wanted to connect with you and talk about that. But I always love to start these things out just by you introducing yourself, maybe your background into civil engineering and how you started all of this.
Yeah, sure. Yeah. So, civil engineer by training, graduated with a degree in civil engineering, structural emphasis from UC Davis. Been practicing the last 20 something years here in California. Been based in the office in San Francisco, but we've done projects all over the U.S., even some international lately. Just been a unique challenge. But yeah, focused heavily on structural building design. Got my SE license back in 2006. Been working as a licensed structural for all that time since then. And then, that it kind of morphed into, I think that it is connected to my interest in real estate, in the sense that I always had an interest in engineering, but didn't know exactly which engineering was my top choice going into school. Mm-hmm. Was drawn towards structural the more I took classes. And I think there was always sort of this underlying interest in buildings. And I think that ultimately was sort of a subconscious connection that has become more conscious the last few years, to connect the dot over to my interest in real estate as well. It's sort of the marriage of the two, the interest in buildings, the interest in engineering, combines sort of that interest in structural and the interest in real estate investing.
I think it's a great marriage of the two.
Yeah.
I definitely would, I feel the same way, maybe a little bit different route on the civil front, but real estate's definitely an interest. And I think it's a big interest to civil engineering professionals that are out there doing this stuff. So anyway, I'm curious, how did you get started in the real estate? You started a group called Progress Capital Group.
Right.
Did you give us a little bit about what's involved there?
Yeah, sure. So, I mean, way back, in the day, the initial interest started the way it does for so many folks, meaning rich dad, poor dad. Sort of having that mindset shift to opening up the idea that earned income may not always be the best choice. There are other options besides just earned income. So that kind of got the wheels turning on, well, what else is there? Again, sort of connecting the dot back to real estate, I think has always sort of been an underlying interest. And so, poked around at some different real estate options, looked at the fix and flip route, looked at potentially, trying to buy properties out of state and, fix them up and rent them out to people. But I think the demands of the engineering job and family and all that sort of stuff just sort of made all of those other routes a little bit more time consuming and complicated than made sense. So what Progress Capital Group is all about, what I do is I do real estate syndications, which is essentially investors pool their money together to buy a larger property than any one of them could otherwise buy individually. So, for example, you could invest, a certain amount of money in combination with a bunch of other people to put a down payment on a 100+ unit building in, let's just use Dallas, Texas, for example, right?
Mm-hmm.
And none of the investors could buy that themselves. As a group, as a collective in the syndication, everybody's money together has the power to purchase something that big. And then there's a professional team of investors, usually referred to as the general partners, who basically are in charge of pulling that money together. They have the liquidity to kind of back the property in the eyes of the bank. The bank has some level of trust in them. And then they operate the property, kind of run the day-to-day situation so that the investors who invest the money just sort of get to enjoy the benefits, but don't have to do the actual operations, property maintenance, tenant interactions, all that sort of thing. So that's kind of my focus, is to help investors connect with those properties and connect with the general partner teams so that they can enjoy the real estate benefits without having to do the work that comes with operating and managing your own properties.
And are there quite a few general partners when you're connecting those dots? And maybe a follow-up question to that is, it sounds like you're trying to maybe gear this to the AEC professionals that are out there, but do they have to be accredited investors? And maybe you could talk about what that is.
Yeah, for sure. That's a great question. So general partners, usually there's a few. There's almost always 1 to 2 who are kind of the lead general partners, also called lead sponsors. They're the folks that generally have the most experience running syndication. They also tend to have the relationships with either the real estate brokers or the banks, or both. So there's that level of trust with those folks having a bit of a track record. And then often there's a few other general partners who are, a little less experienced maybe, or have a certain skill set that the lead general partners aren't particularly fond of. So the collective of, like, say 4 to 6 folks at most are kind of the general partnership team running different aspects of the property. It works well. Everybody kind of has their own little niche and their own little thing they're good at within the team. And so, it just like, in a building design or any kind of project that engineers would work on, everybody's got their own level of expertise. You got your structurals, your civils, your architects, your mechanical engineers all doing their own thing, coming together to put a project together. It's kind of the same idea with the general partnership team. Everybody's got their own piece that they like and that they're good at. Yes, to answer the second part of your question, I am putting a focus on trying to help AEC folks with finding real estate investment opportunities that matches up well with their goals. I think AEC folks don't recognize the level of skills that they have to be good investors. I think everybody's so busy. Everybody's so focused on perfecting their engineering craft, and just the rest of life being busy, that there's not a lot of time and ability to really put the focus on also happening to learn real estate investing at the same time. So I'm out there kind of trying to help get AEC folks educated as to what syndications are, what the benefits are, and really why they're good at being investors. Engineers are sort of, inquisitive by nature. We want to know a lot of answers. We ask a lot of questions. We're good at understanding numbers, so the financial analysis is never too difficult. We're good at questioning numbers of where did you get that? Like, how did you come up with that number?
Mm-hmm.
So there's a lot of good due diligence that sort of naturally comes with being an engineer or an architect or a contractor, really. There's a lot of good questioning that comes from the industry that it translates well to real estate. So yeah, I'm trying to help educate and introduce the concept and help, match up the investments to AEC folks as much as they can to really kind of help, really improve their access to it, and potentially, add a little bit more diversity to their portfolio. You had mentioned accredited investors. I do want to touch on that before I forget.
Yeah.
So there is a status called accredited investors. That is defined by either your income or your net worth. The income requirement is either a salary of more than $200,000 per year for an individual or $300,000 a year for a married couple. The net worth requirement is you have $1 million net worth, excluding the value of your primary residence. So those are the two ways you qualify as an accredited investor. If you are accredited, you get to invest in multiple different types of investment opportunities. There are two main types, a 506B and a 506C are the SEC regulation code names for them. The 506C is for accredited investors only. The 506B is for a mixture of either accredited or non-accredited investors. So if folks don't meet the qualifications of being an accredited investor, it doesn't mean you can't invest. It just means that your options are a little bit more limited. You have to look at only 506B options rather than the B or the C options. But there are a lot of opportunities for folks, whether they are accredited or not accredited.
So maybe just to back up a little bit, if you're a general partner, is your investment opportunity better in terms of a return on your money? Is it better if you're an accredited investor? Is it less if you are just in that, what did you say, the 503B?
Yeah,
kind of open to every 506B, open to everybody category. So, I mean, does those correlate to kind of what's good, better, best, or should every engineering professional have a goal of trying to become accredited because that's going to be a better option for them?
I think that being accredited does open up more opportunities. So always, I would say that should be a goal for folks, but it doesn't have to be a requirement. I know in California, making those income thresholds is a lot easier to accomplish than, certain other parts of the country. And so, unfortunately, the SEC doesn't distinguish between where you live and what your income is. So the folks who live in high income areas, even if it costs a lot to live there, they still have a tremendous advantage towards being accredited than folks who live in, sort of lower income areas.
Makes sense.
And it's a little bit unfair, quite frankly, I think, but it's just how the rules are set up, and I'm not going to get a vote to change it. But the investment returns for most deals are very similar between a 506C for accredited folks and a 506B for accredited and non-accredited folks. The reason that most general partnerships would choose to go with a 506C is because there's a little bit less paperwork involved for the general partnership. And they can accept more people in total than they can accept in a 506B offering. And so it makes the logistical paperwork side a little bit simpler for the general partnership team to do the 506C option. But there are still plenty of opportunities out there for the 506B for non-accredited folks. And like I said, the investment returns generally are very similar between the two. As far as the returns that the general partnership gets, in a properly structured syndication, the investors, known as the limited partners, should be getting a return on their investment before the general partnership sees any return at all. So the general partnership generally gets an acquisition fee as a way for compensation for all the work that goes into finding a property and doing all the upfront due diligence to vet the property. And then after the acquisition fee, the returns throughout the life of the property, there's generally a preferred return where the LP investors, basically the money partners, get paid a preferred percentage annually. And if that threshold is not met, it tends to roll over year to year, and that needs to get paid before the general partnership team sees any payments. Once they go past that preferred return, then there tends to be a split in the investment return, generally in the 70-30 range, where the LP investors get 70% of the returns beyond that threshold, and the general partnership gets 30%. There can be further complicated waterfalls where you get past certain, and it splits again, and it splits again. And sometimes it can be overly complicated. But the overall message is the LP investors should always get their returns before the general partnership investors. And then at the end, there's usually what's called a disposition fee, sort of that goes to the general partnership team. That's sort of the compensation for, getting the property up to the level where, you can make the returns that you're targeting. And then the net proceeds are essentially split between the LPs and the GPs in some form. It generally varies between 50-50 to 70-30 again, with the 70 being the LP side. So
okay,
the returns are usually very favorably skewed towards the LP investors.
No, I think that's a good thing, right? You're trying to,
and should be.
Yeah. So in terms of like percentages, and we're trying to interest this engineering professional that wants to, say, invest in this stuff. Most of us are investing into a 401k with our employer. What would be the biggest, what's the big benefit here of trying to go into syndications? How much of an advantage is there to go that way in terms of a return on your money?
Yeah. So I don't know about everyone else's 401k options, but I know mine are pretty limited. You've got a handful of funds you can invest in. Oftentimes you can't pick individual stocks. Sometimes you can, but in the ones that I've been part of, I've not been able to do that. So everybody's heard about NVIDIA lately, just shooting through the roof, it's skyrocketing, right? Well, great. Maybe one of the funds that you're in owns a small piece of that, but that's a small piece of that fund. You can't, in your 401k, take advantage of all that skyrocketing from NVIDIA, right? So what I find is the investment returns from a lot of the options in the 401ks are pretty mediocre. And then, you subtract fees on top of that, and it kind of stays somewhat mediocre. And you're sort of riding the wave of the stock market. When the market goes up, your stuff goes up. When the market goes down, your investments go down. There's no real, negative correlation between that kind of stuff. It's all directly correlated to the direction of the market. Why I like the opportunity for real estate investing is that it's not a correlated asset. It does not move in lockstep with the stock market. The real estate values have been a little bit soft, I guess I'll say, over the last, 12 months, primarily because of interest rates, and real estate values are sensitive to interest rates. But the stock market has been a pretty wild ride over the past 18 to 24 months as well. They don't move together, though. If you have a good real estate property, you can still do quite well these days. If you're operating it correctly, things are still in good shape, and you're not necessarily on that same roller coaster that you're on if you're in the stock market. I like the idea of non-correlated assets just because it essentially, as we were discussing a minute ago, it offers a little bit of redundancy and a little bit of diversity. in your investment portfolio and you're not relying solely on one particular asset. I mean, as engineers, we are always looking for ways to improve the redundancy, and the diversity, and, the looking for, ways to not find a single point of failure sort of thing in all of our designs. For me, real estate is totally that, that investment option that does that, in contrast to the stock market. And so I wouldn't suggest that folks, sell all their stocks and buy 100% real estate either. I don't think that makes a ton of sense for everybody. It might make sense for some folks who have a lot of capital to invest and can deploy capital, in all sorts of different real estate markets. But if you're just looking to add, take some of your investments and move them to some different asset class for diversity, I think real estate's a great option to add, in addition to keeping some stocks, some 401k, all that kind of stuff.
Definitely makes sense.
Returns wise, most real estate syndications should be returning somewhere between, 6 to 14% annually, depending on, where the investment is and what the business plan is for that particular property. And most of those returns are calculated after the GP and the general partnership fees are taken out. So for me, it's always been one of those things where you got to understand, am I looking at before fee returns or am I looking at after fee returns? And most syndicators will present the after fee returns, whereas most mutual funds and 401k options will present you the fee or the returns before the fees are taken out. And then they've got those little tiny numbers on the side to tell you what the fees are, so you can do your own math to figure it out. But if you don't do your own math, then you're kind of getting a little bit duped into thinking you're getting more than you really are.
Management fees.
Yeah.
So that's great. If you had as high as 14% return on your money, that's awesome. Mm-hmm. Are you also getting your initial investment back? So if, let's say you had to throw in $100,000. Mm-hmm. You're getting 14%. Your money's probably in there for some amount of time.
Yep.
5-ish years, I guess.
Yeah.
Is the whatever piece of property that you're buying, is it eventually sold? Is it refinanced? Is it held long term? Are there just options depending on how the market is?
Sure. Yeah, good questions. And the answer is really all of the above. It depends on the business plan, right? So, and it depends a little bit on market conditions. In most syndications, the projected hold period is about 5 years. So you were right on with that. And most syndications are the exit strategy is to sell at the end of those 5 years. So you buy an asset that's either undermanaged or, hasn't been improved for years, and you spend some money to improve it, to raise the rents, increase the operating income. That higher operating income then increases the value of the property. Value is based on the operating income, and the capitalization rate is essentially a market specific number that is used in combination with the net operating income to determine the value of the property. So the net operating income is divided by the cap rate to determine the value of the property. So if you increase the operating income, you're increasing the value of the property. Over those 5 years, the goal is to increase the operating income by making improvements to the property and then sell it at a higher point than at which you bought it. That is the most common strategy for syndications. And then at the end of that 5 years, yes, you get your initial capital back plus your return, which, if you're anywhere from 6 to 14% a year, the goal for most syndications is to essentially double people's money in the span of that 5 year hold cycle. So if you invested that initial $100,000, at the end of the 5 years, the goal would be to return $200,000 to the investor who invested $100,000. So they'd get their initial 100 back plus $100K return on their investment. And that includes any cash flow that they've been paid out over the course of those 5 years and the net proceeds at the end of the hold period when the property is sold. There is also the strategy of refinancing. That's a strategy that I particularly like. If you can take a property and improve it to the point where you can refinance it and return, 70% or more of the investor's initial capital, then they have that capital to either, to deploy again into another investment or do whatever they will with it. But let's assume they deploy it to another investment. Now you've taken that initial 100,000. If you got 70 back, let's say, you still have 30 in the first property. You can take that 70 and potentially invest it in a second property. Now you essentially have 170 deployed across two properties with only using $100,000 to start. So you can really accelerate the velocity of your money with the refinance and reinvest strategy. Those properties, they'll generally refinance, anywhere from like 3 to 4 years into the hold period, return as much capital as possible. And then generally there's another sort of 3 to 4 years of holding period after the refinance before it's then ultimately sold. Most syndications don't hold long-term. There are a select few that do. The ones that do hold long-term are the ones that can set it up where you can refinance it and return 100% of the investor's initial capital. And then at that point, everybody's in essentially for free. And then you can sort of hold indefinitely as long as it makes sense to hold that property. So there are some folks that take that strategy, but it's not the most common.
And I have so many questions, and I feel like our time's running out. So I imagine there's huge tax benefits to doing this too. If you're throwing that much money into it, and there's probably a significant write-off if you're going into syndications.
There is, and everyone should definitely consult their own tax preparer with their own situation. I'll always throw that caveat in there. But the government doesn't want to provide housing for people. They don't want to be the ones responsible for building it. So they basically set up the tax code in such a way to incentivize others to do it for them. And real estate ownership is one of those things that is heavily incentivized in the tax code. There are multiple ways to write things off. There is depreciation, where you can basically, deduct a portion of the cost of the asset, even though the asset is an appreciating asset, which is always confused me because it doesn't apply. Logic doesn't apply. And being the engineer that I am, logic is usually where I start, but the tax code isn't always based in logic. So to depreciate something that also appreciates, it's a tremendous benefit. Some folks can qualify for what's called bonus depreciation. This was something invented by the Congress in the COVID years to help, keep things going. Bonus depreciation means you can do a study on the property to accelerate the depreciation on certain pieces of the property and take advantage of a faster depreciation cycle on certain aspects of the property. So, and passive income is treated differently in the tax code than active income. So, whatever your tax rate is for a given individual's tax bracket for earned income, their W-2 salary, passive income doesn't fall into those same tax brackets. It's treated much more favorably. So you pay less taxes on the same amount of income for most folks with passive income versus earned income.
That sounds awesome.
Yeah. W-2 income is very unfavorable from a tax perspective. But there's a reason why most people earn a W-2 salary. And so that, government charges the greatest amount of taxes on the largest pot of money, essentially.
Yeah. Well, it sounds, like syndications are a win-win. I'm curious, as civil engineers, they're typically risk adverse, but are syndications always a win, or what are the risks involved with doing syndications?
Yeah, that's a good question. Because I do find that civil engineers, all engineers, very risk averse crowd. And it's good for the profession that we are risk averse. It helps keep, infrastructure going. It helps to save people's lives, all that sort of thing. There are always risks with every investment opportunity, for sure. I think the biggest thing with syndications is making sure that you find the right general partnership team. And I think that it's a combination of finding the right folks who have the experience to know how to operate a property correctly, because anybody can buy a property. Anybody can kind of get lucky and acquire a property. Operating the property is really where all the money is made. You got to buy right, but folks who don't know how to operate can take a good property and kind of drive it into the ground. Folks who know how to operate can take a good property and turn it into a real win. So finding the right general partnership team is key. Understanding the markets is somewhat key. I think it's important to know the trajectory of a market that you're looking at. But I don't think LP investors in syndications need to know all of the ins and outs of a market that they're investing. I think they just have to have a general idea of, are there more jobs coming? Is the market growing? Is the population increasing? Is there continued economic growth prospects for this market? And those are really kind of the key pieces to finding a market that makes sense for investing in real estate. If the market's growing, more jobs are coming. That's always a good sign for continued demand in rentals, and therefore, continued demand in apartments and continued growth in rent rates and that kind of thing. But I don't think everybody has to be an expert in the market. But talking to different general partnership teams, finding a group that you connect with, finding a group that understands your goals and has investment opportunities that align with your goals, and a group that communicates really well is, I think, the key to really having a successful investment opportunity.
Makes sense. Well, man, I have a million other questions, but I know our time is short. So why don't we just kind of end with this? Why don't you tell us a little bit about Progress Capital Group, maybe the website, what investment deals are out there, and how an engineer could get started into this journey, whether it's, I don't even know, can you move money from a 401k into this, or do they need to come up with their own money? But maybe what are the ways people can get started?
Yeah, sure. So Progress Capital Group is my company. I help AEC folks and really any other busy professionals that are looking to get into real estate syndication. I help educate and connect them with the general partnership teams that I work with and the deals that we provide. I'm always been a huge fan of teaching, and so I'm always happy to help educate folks and give folks resources that can help get them started. And then I'm happy to help fill in the gaps and continue that process of learning more about it. I do have a website. It's progresscapitalgroup.com. I have an ebook that is my top 7 reasons why I think real estate investing makes sense in addition to stocks. That's progresscapitalgroup.com/7 reasons. If you want to go to the link for the ebook. If there are any engineers out there that are interested, you can look me up on LinkedIn. I'm Brian Armstrong, SE. You can send me an email, brian@progresscapitalgroup.com. Happy to answer questions. Happy to get on a call if anybody wants to ask a question live. How do folks invest? You cannot invest directly from your 401k. This is excluded from those options because the companies that run the 401ks want you to invest in their products. They don't want you to invest in other people's real estate products. So the most common way that I will say is either you have cash in an investment account or cash in a savings account, and that can be the capital. Or if you want to use retirement funds, people can take old 401k accounts, probably not from your current employer, but from previous employers. You can either roll over or consolidate multiple previous 401ks into what's called a self-directed IRA. And it's not all that well known, not very well publicized because, the big brokerage houses don't offer them. But there are some smaller companies that do offer self-directed IRAs. They essentially work very much like a 401k, the way the rules operate, but your investment options are way more open to whatever you want to invest in. So you're not limited to just the few choices that are in your 401k. Your options are much, I won't say limitless, but much more open to other options, individual stocks, crypto, gold, real estate. There's much more flexibility with the self-directed IRA. So that would be the way if you want to use real estate or retirement funds, then I would say it would make the most sense. And a lot of people do that.
And is a typical investment start at what, 50K, 100K? What do we have to do?
It's hard to find the 25K investments. There are a handful of them. They are not very common. Most of them start at $50,000.
Okay.
So that's where retirement funds can also come into play. Not everybody has $50,000 just sitting in a savings account, waiting to find its investment home. But over the years, you can amass $50,000 in a retirement account that you may want to redeploy some of that into something that's not, just stocks or the choices in your 401k. So 50K is usually the minimum.
And if you started with 50K, maybe give people a vision of how that could multiply for you. I know we talked about that just a little bit earlier, but with syndications, it sounds like, you can reinvest this after it grows and all of a sudden it's really taken off.
Yeah. Even if you take the slow road and you go every 5 years where you invest 50K and 5 years later, you end up with 100K. Let's say that one was successful in its targets and it doubled your money in 5 years. Now you've got 100K that you can redeploy into two investments, 50K each. And then you've got 5 years later down the road, you've got 200K, and then you take that and deploy it into four investments. And 5 years after that, your 200K goes to 400K, and that's the slow motion version of it really. And it can kind of keep going like that. So I'd have to do the math on it quickly in my head, but you can get, over $1 million in, I'll call it relatively short order. I think that growth is faster than a lot of what you're going to get out of most 401k choices, in my opinion. So
yeah, sounds way faster.
Yeah.
Well, I like it.
Velocity of money.
Well, I appreciate you jumping on and sharing all of this knowledge about syndications and opening, hopefully, a lot of engineers' eyes to what's out there, or maybe set a goal to just start this adventure. But appreciate you doing it. We'll go ahead and leave all of those links that you've mentioned to your website and make sure that people can reach out to you on LinkedIn. So appreciate you sharing all this knowledge, and maybe we'll have you come on in the future and we can talk about this a little more. I still have a ton of questions, but we can talk about them later.
Yeah, sure. I'd be happy to come back and do another round or another 2 rounds or whatever it takes to share what I know and get folks comfortable with the idea. It can seem a little intimidating at first and something new, something, most folks haven't really spent a lot of time learning about, but it has a lot of power to it. And it's not nearly as complicated and scary as it might seem at first. So, that risk aversion does hold people back, I think. But I think that if folks can get past that, there's a lot of opportunity here.
Sounds great. Thank you, Brian. We will talk to you later.
All right. Well, thanks so much for having me on.
See ya.